Hello and welcome to the Stock Planner channel. What is return on capital? That's our topic for today. The Stock Planner channel is an education channel. We want to learn from each other, share some ideas. No one is advising anybody of anything. In fact, in many areas, I'm learning as well as a beginner. We learn every day, and I've been doing this for 20 years. My background is programming, and it's not in finance. So there's areas that I sometimes get confused. This is one of those areas, return on capital. I see it mentioned a lot and never knew how to use it. So I'm going to share some ideas, just share a little knowledge, and maybe you can apply this to some of your analysis. Return on capital is very interesting. Return on capital, sometimes ROC, or return on invested capital, is a ratio used in finance. It's a measure of the probability and value creating potential of a company relative to the amount of capital invested by the shareholders. In other words, does the company that you're investing in put good use to their capital and grow their revenue and customer base? Good use of capital. And I can tell you these four companies here, Google, Amazon, Facebook, and Apple, and John Deere, and I think Caterpillar. We'll look at those too. But they all put good use, they put their investors' money to good use and invest in themselves and invest in new businesses and grow their companies. ROC measures how well a company turns capital into profits. Use of money. And you must ask yourself, when you invest in any company, does a company put good use of your money, and does it grow its revenues and profits? But you got to look at some indicators that will show growth. Let's go a little further and see if we can use some examples. This is a Simply Wall Street article that may help us understand this return on capital. And they're saying that John Deere does just do that. And I think John Deere will do well in our inflationary type of economy. And I believe based on the stimulus and the infrastructure plan, John Deere should do well, so should Cat. And here's the calculation. Let's not go into that. But this is a snowflake for John Deere, and it's saying the health of the company is very good, the past history, and it pays a dividend, and the future is growing, but we don't have as much filled in on this snowflake. You want to have as much green as you possibly can, but this is pretty good. And this is the calculated return on investment from 3 years ago, for the last 3 years. And this is the return on investment, ROC, return on capital, for this year. And you can see this was around 9%, and now it's 12% or 13%. So it has, over the last few years, added value for its stockholders. So you can calculate it if you want, or you can go ahead and use a tool, which I use, and just look. So we can see that returns have grown over the last 4 or 5 years, and that's good. And they probably continue to grow. This is Caterpillar, and the snowflake is very similar to John Deere. Health is great. Future looks a little brighter, and the dividend, it pays a nice healthy dividend. Earnings are expected to grow 16%. That's good. And earnings have grown 30% over the past 5 years. That's great. It's growing, just like John Deere. And these are similar companies. Cummins, which, by the way, I don't have that on my watch list. That's interesting. CMI. That's a company that I have name recognition, but I never traded it. This company is a little overvalued. There's the earnings and revenue growth. Earnings fairly level. The revenues are growing. This is the forecast for earnings growth. Company looked good. Looks great there. The earnings per share growth, that's as good as it gets. Future return on equity. The industry's here. And look at this for the company. Last year it had a little trouble with its earnings growth. For the past 5 years, it's been knocking it out. And here's your return on equity. And there's your industry again. And this is return on assets. And it looks like it's consistent with the industry. And we got the ROCE, return on capital employed. Last year was 11, and 3 years ago it was 15, so it dropped a little bit last year. But I don't think it's by much. Looking at other companies with capital goods, using this tool, there's lots of eligible companies, of which I don't know the names. So, of course, I understand John Deere and Rockwell And you can get a good idea with the snowflake, and it pays a dividend of about 2%. But we can see that Caterpillar and John Deere both are doing quite nicely in return value for their customer. I would have no trouble investing in either one. John Deere, you could wait a little bit and buy this on the dip, and the same with Caterpillar. Wait till it finishes its drop and buy on the dip. These stocks are going to go up, especially if the infrastructure bill passes. Well, let me know what you think about this return on capital. Please like and subscribe. Leave your comments below. Catch you on the flip.